Hi there, this is Chris from MoneyHub, and this video looks at how to use a personal loan repayment calculator. So if you are looking for a personal loan, then it's pretty normal to try out a calculator just to make sure you understand how the repayments will work, what the costs will be. And we've published one here, which I've linked to below, to help you do just that. So let's go straight to it. And there's 4 inputs here that you need to know about. So most often, the personal loan that you're applying for is going to be principal plus interest. That means that you're going to repay the loan at the same time as you repay the interest. There is another option. This is usually quite unique in cases of personal loans, and it'll be interest only. But that's just where you just pay the interest, but at the end of it, you've still got the balance. That's very rare, so that's preset to principal plus interest, which is the standard. Now, if we were going to get a loan, say for $20,000, a personal loan, then we'd put in $20,000 there. And then if we wanted it for 5 years, then we would set that for 5 years. And then if the interest rate is going to be, say, 15.99%, it's a very precise number, but sometimes we see those rates around. It's a high rate, but it is one, and I'm just using for an example. So what we'll see there if we come down is we'll see that if we look at it weekly, that the personal loan repayment is going to be $112 because you've got $20,000 to pay, and it's going to be over 5 years. That means that the total interest cost is going to be $9,000 because you're effectively paying a lot of interest over the 5 years. If we shorten the term to 3 years, we can see that that $9,000 is going to become $5,000 because, of course, the loan is sped up, the repayment, so there's less interest being incurred. That's a really important thing because that will lower the overall total cost of your personal loan. What we don't include is personal loan fees. Now, often you'll be charged an application fee if you go through with the loan, not actually at the application stage, but at the point that you draw it down. So be aware of that. You might want to add those in because usually those are fees which you pay back plus with the interest. So for example, if it was $250, then you'd put in a $250 there to your $20,000. Say the term was 2 years, and then say the interest rate was 20%. Once again, very high, but I'm just using this for an example. Then you can see that over those 2 years, you'll pay back $4,000 worth of interest, but you'll pay $237 per week. What you will notice is that if you look at the monthly, then the total interest cost is higher, just not by too much. If we compare weekly, it's 4,358, and monthly is 4,485. The reason that's higher is because if you repay every month, then it takes longer to get repaid. The lender gets repaid slower. Whereas if you're paying weekly, then the principal, that original $20,000 and $250, that's coming down quicker, just because you're making weekly repayments. So the debts, it's not going to be a huge difference, but it does get paid off marginally quicker. Fortnight somewhere in between, as you would expect. So please just play around with this. We've put a lot of effort into making sure that it's sort of simple to use and just gives you an indication. One thing I do want to make clear is that, if you do miss a payment on a personal loan later down, then it's going to have severe consequences on your credit history, and it's going to make borrowing in the future far more difficult. So just be aware that whilst an interest rate may seem attractive, or the fees may seem low, or the term is good, make sure that you can afford it should something else happen in your life. You need to prioritize other payments, because too often, and it's really unfortunate, people struggle to keep up with these personal loans. So we just really want people to know that it needs to be stress tested. Never borrow more than you can afford to repay. That does sound obvious, but there's so many stories in the media of people with mortgages not being able to repay them. Now, personal loans, you're certainly not as significant as it, like not being able to repay a mortgage, but at the same time, very stressful. So too many people struggle with this. Too many people then have to go and refinance at a higher rate, and then they're pretty much in debt for much longer than they expected to be, which costs them a lot of interest. So usually personal loans used for large purchases, cars, home improvements, weddings, even holidays. We do understand they are popular. There's nothing wrong with them. You just have to be very careful how you how you draw them down. Make sure that they're, you know, always used for something that you need, not want. Secondly, that you can keep up with the repayments. The interest rates will be fixed. So when you are, you know, lending, so when you're borrowing for an amount of, say, 2 years, 4 years, that's always a fixed rate. But if you still haven't paid it back at the end, and sometimes that does happen, you may go on some sort of repayment break or like negotiate something, then you'll need to refinance. And that refinance is then done probably at a different interest rate. We can't comment on what that will be. That'll depend on what loan you have left or what loan that you need to be that you need refinanced. One thing is, some lenders, and we're not that happy about this, when you're coming down to paying off your loan, they will send out offers for new loans saying, oh, it's great, you've repaid your loan, and you know, or you're about to repay your loan, here's a new loan, we can give you this promotional interest rate. We just want to say, please be very cautious of that, because it's very easy, you know, if you're paying 20% like interest rate per year, you know, that certainly adds up on money like that. You know, if I did that for 1 year, if I just show you what that costs for $20,000, we do that weekly, then the total cost of interest per year is going to be $20,000. And, you know, you need to earn at least usually $2,500 to pay for that, because of this is an after-tax payment, plus all the repayments that go with it. So we just want people to be aware that, you know, getting new debt out after you've paid off old debt, it's not great unless you actually need it. So just be aware, because I know the marketing pool is very, very strong. I've seen some of it, and I'm not happy. But just do be aware of that. So thank you very much. If you do have any questions, please leave them in the comment section below. We're very responsive to any comments that are left. We want to constantly improve our guides, and questions do help us do that. So we really appreciate anything that you'd like to share or comment on. Thanks very much.